Hello, in this video, we'll be going through some additional earnings per share issues and how they get reported for financial reporting purposes. One type of additional issue when it comes to earnings per share is how to deal with the restricted stock awards and units in the diluted earnings per share calculation. If you recall, the diluted earnings per share calculation includes any dilutive securities, which means that they have the potential for additional common shares to be exercised, issued, or converted. And restricted stock awards and restricted stock units both have that potential. In restricted stock awards, the recipient is granted an award, and at that point in time, the company actually issues common stock. However, the recipient is not able to sell it or trade it, even though they technically own it, because they're not actually vested in it. Restricted stock units are similar in that the recipient receives stock when they finally vest in it. However, they are not actually issued stock, they're just rights to stock. But for restricted stock awards and units, what's important to note is that once the recipient vests in those awards or units, then they just receive the shares. They don't have to pay for it. There's no exercise price or a predetermined fixed price that they need to pay for those stock before they can actually sell it. So they just receive it outright. So that's a big difference between stock awards and units versus stock options. So in any case, they represent potential common shares and affect the diluted earnings per share. So how do we account for that in the diluted earnings per share? Well, if you recall, for stock options, right, which have an exercise price, that we assume for the diluted earnings per share that all the stock options are exercised, which means that the recipient sells all the options, and then so the corporation gets cash for those purchases, and then they take the cash and they buy back those shares in the open market using the average market price. And so for stock option, we say, well, our shares outstanding increase because the recipient actually sold it, but then they're decreased because the company buys them back. And the net difference is if it's a net increase to the shares outstanding, we increase our denominator by those number of shares. So similar to stock options, the shares that are added back to the denominator and then reduced by the number of shares that can be bought back with the proceeds at the average market price of the company stock is also utilized for restricted stock awards and units. So we kind of use the same theory. However, when we're talking about restricted stock awards and units, the recipient doesn't actually have to buy shares because they already just get them outright, because they're automatically issued to them upon granting. So it is automatically outstanding. So there's no real proceeds that are received by the company because the recipient didn't have to sell those options because they're not options, they're restricted stock awards and units. So the first component, there's the proceeds that we quote unquote receive, but that's usually not applicable to awards and units because employees don't have to actually pay to acquire their shares. For the shares that are actually fully vested, then at that point, they're whether they're granted or at the date of grant or date of vesting, depending if they're awards or units, the corporation is going to record common stock issued. And at that point, that's just going to be part of your basic earnings per share calculation because it is actually outstanding. There's no assumption that needs to be made. So where we make assumptions is related to the unvested restricted stock award shares and RSUs that we're going to include in the diluted earnings per share calculation. So Since the recipient never has to buy those shares because they just own them, and the corporation never actually gets any cash from a sale because the shareholders, the recipient just owns those shares outright, what we do is we're going to take the total compensation from the unvested restricted stock that's not yet expensed. And that's really the key. It's the portion that has not yet been expensed. Use that as our proceeds. We'll go through an example and I think it'll make much more sense. Okay. Under its restricted stock unit plan, Universal Communication grants RSUs representing 5 million of its $1 par common shares to certain key executives at January 1, 2027 at the current market share of $12. The shares are subject to forfeiture if employment is terminated within 4 years, and shares have an average market price of $15 per share at 12/31/2027. So first we have to say, how do we calculate the compensation expense for these shares? And we're going to take the total number of shares granted multiplied by the market share at the date of grant, which is $12. So we're going to have $60 million of compensation expense related to these RSUs, and their vesting period is 4 years. So we're going to spread out that compensation expense over 4 years, which means we're going to expense $15 million per year starting in 2027. Okay, so when we're looking at when we're doing our diluted earnings per share and we have to increase our denominator, right? We have to increase our denominator by the additional shares issued and outstanding because we assume that they're all the unvested portions the proceeds are going to be used to buy back those shares as treasury shares. So we're going to look at our 60 million, but 15 million has already been expensed in 2027, right? Because it's one of the 4 years. So we have $45 million of compensation expense remaining related to those the remaining unvested shares. So that's going to be what we assume is kind of like the proceeds. I'm going to say proceeds in parentheses, right? That the company uses to buy back shares. And when they buy back the shares, so they're going to take their 45 million and they're going to buy back the shares at the average market price of $15. So they're going to be able to buy back shares of 3 million shares. Now, again, I just want to reiterate that this actually has not happened. This is just for purposes of calculating the diluted earnings per share. None of this happened, right? The company did not receive $45 million. The company is not buying back 3 million shares. This is just all for this calculation, these assumptions that we make. So when we look at our diluted earnings per share, the adjustment that we need to make for the diluted earnings per share at the end of 2027, we have no adjustment to the numerator. Remember, the numerator is going to be net income minus preferred dividends paid, accrued, or owed. And it's the denominator that we're going to make an adjustment to for the additional outstanding shares that we could potentially have. And what it is we say, okay, well, we're going to issue 5 million shares because that's how many were actually granted. But then we're going to buy back 3 million of those shares. So our denominator is going to increase by 2 million shares when we calculate the diluted earnings per share. Let's look now to see, let's move forward, the same example, except now we're going to go to the end of the next year of 12/31/2028, and we're going to say in 2028, the average market price was $20 per share. So again, our total compensation expense over a 4-year period is going to be 60 million, but now at the end of 2028, we've expensed $30 million of it, and now we have $30 million remaining to expense for those unvested restricted stock units. And that's what we're going to use as our proceeds, our fake proceeds really, to purchase back those shares as treasury stock. So we're going to take the 30 million and we're going to divide it by the average market price for that year for 2028. And so we say we can buy back 1.5 million shares using that 30 million. So for the diluted earnings per share at the end of 2028, the second year, again, no adjustment to the numerator. But now we're going to say, okay, well, we're going to issue 5 million shares, and now we're going to buy back 1.5. So it's the denominator will increase $3.5 million at the end of 2028. And I just want to point out that this 5 million in 2028, we still have to add it back because none of these shares have actually vested. So look at it as almost like a fresh year. It doesn't matter that that 5 million was used in the 2027 EPS because 2028 is its own calculation. So we say, okay, we're going to issue outstanding common stock of 5 million and then buy back the 1.5. There's other issues with earnings per share, and these are called contingently issuable shares. And these are potential shares of common stock that might be issued, but they're contingent on occurrence of some future event. And these contingent shares can be granted to shareholders of a company that we might be acquiring. It can be issued to certain key executives or others. And it's determined to be issuable, meaning it will be actually be issued if a certain level of performance is achieved. And that kind of performance might be like if a company gets to a desired level of income, if they have a certain target stock price that they achieve, or some sort of other measurable activity level. So how do we account for these potential common shares to be issued? Because we don't know if they're going to be issued because it's contingent on some sort of level of performance, right? So here's what the rule is. It is considered to be outstanding in the computation of diluted earnings per share if the target performance level already is being met. Okay, so let's go through an example. Let's just say there's some shares that were issued and the contingency is that they will only be issued, right? The recipient will only receive those shares if the company targets $150 million in net income next year. So here's the example. Sovereign Financial Corporation reported net income of $154 million in 2027 with a tax rate of 25%. Now, assume that 3 million additional shares will become issuable to certain executives in the following year, in 2028, if the net income that year is $150 million or more. So to determine, now we're working on the 2027 diluted earnings per share to determine should we include these additional 3 million shares in our denominator, right? Because they might be issued, they might not. So if the target has already been met, then we're going to include them in our diluted EPS. So we're told in 2027, the company has $154 million net income, and the target for 2020 is 150. And because 2027 already met that criteria, we assume that it will also meet in 2028, and therefore that additional 3 million shares will be included in our 2027 diluted earnings per share calculation. When we're talking about these contingent issuable shares, there's no adjustment to the numerator. Now let's just take similar facts, except the target income next year is $160 million. Okay, so in this situation, in 2027, we still have our net income of 154, which is less than what the target is for 160. So we have not met that criteria in the current year. So therefore, when we calculate the 2027 diluted earnings per share, that additional potential 3 million additional shares are ignored because we have not met that criteria yet. The next couple of slides are just basically summaries that reflect previous videos of how to account for the dilutive effect reflected in the earnings per share. And these are the convertible or dilutive securities. It tells you, are these dilutive securities included in basic earnings per share or diluted earnings per share? And then this, I'm not going to go through this one by one, but this is just another sort of table summarizing all the dilutive securities we've talked about in the videos for this chapter and how they affect the numerator versus the denominator when you're making those modifications to calculate the diluted earnings per share fractions. So you can take a picture or write things down that you want, but here it is. So one of the dilutive securities we've talked about is convertible bonds. And convertible bonds, if you recall, are bonds that are issued by the corporation, but they have a feature in it where the holder of the bond can actually convert those bonds into common shares. And so we always include those in our diluted earnings per share calculation, well, barring that's anti-dilutive, but in general, we include convertible bonds in our diluted earnings per share calculation, and we assume that all of the bonds are all converted into common shares, right, as of the beginning of the year. So what happens when actually, right, in reality, some of those bonds are actually converted to common shares? So how do we account for that in our diluted earnings per share? Well, I'm not going to go through the whole calculation to prove this out. You can look at this in the book because they do go through a calculation. But just know that even when a convertible bond is converted into actual shares during the year, if you assume that all the bonds were converted at the beginning of the year, your diluted earnings per share will not change. It will be the same, which is why I'm not going to go through the whole calculation, because if you just assume that the conversion happened at the beginning of the year versus if it actually happened at some point during the year, the totals will be the same. And here's just a footnote that was in the Clorox company's financial 10K. And it says a $9 million note payable to Henkel Corporation was converted into 1.2 million shares of common stock on August 1, and earnings per common share and weighted average shares outstanding reflect this conversion as if it were effective during all periods presented. So basically, it's saying that this note payable, which is kind of like a bond payable, were converted on August 1, but when we're doing our earnings per share calculations, it's reflected as if it happened at the beginning of the year. Now let's talk about financial statement presentations for earnings per share. Both basic earnings per share and diluted earnings per share must be reported separately must be each reported for a corporation, and they must be reported separately from the net income. And additionally, if the company has continuing operations and discontinued operations, then they have to separate the earnings per share between the two and separately state them. And for the discontinued operations, the earnings per share amount can be disclosed either on the face of the income statement or in the notes for the financial statements. And both the basic and diluted earnings per share information has to be reported for all the reporting periods presented in the comparative statements. So if you look at a 10K, the income statement is for 3 years. They present 3 years worth, and that's where you'll see the earnings per share on the bottom, the statement of operations, which is the income statement. And businesses that don't have any dilutive securities will not have a diluted earnings per share, so they only have to report their basic earnings per share. This is just an example of Stanley Black & Decker from 2022 how they reported their earnings per share and their net income. And in those 2 years, they had losses. Okay, they had continuing operations and discontinuing operations. So you can see that they reported net income from continuing operations and net losses from discontinued operations, which is pretty typical, and to get to the total for each of the year. And then they have their basic earnings per share and their diluted earnings per share. And again, they're broken out between their continuing operations and discontinuing operations for each one of those categories and for each year presented on the financial statement. In addition to just presenting the earnings per share number itself, there are additional disclosures required. There needs to be a reconciliation of the numerator and denominator using the basic earnings per share and the diluted earnings per share. So you have to take it from the earnings per share denominator and show how you got to the diluted earnings per share numerator and denominator. And you have to show any adjustments to the numerator for the preferred dividends, right, for the diluted earnings per share adjustment, and any potential common shares that were not included because they were anti-dilutive. So if anti-dilutive is when if you layer in that dilutive security, it would actually make your diluted earnings per share increase versus decrease. So you're only allowed to report the diluted earnings per share that are less than the basic earnings per share. But you still have to report in the disclosures which ones were anti-dilutive that you did not include. And also any transaction that happened after the end of the most recent reporting period that would materially affect the earnings per share. So if there was some sort of big event that would affect on a material basis your earnings per share, you have to report that as well. So let's look at our this company that we've been working with in all these videos related to earnings per share, the Sobran Financial Corporation, of how it would just be presented this in the disclosures, the reconciliation between the basic earnings per share to diluted. And here we have our income, right? Income for common shareholders or earnings for common shareholders, and that's going to be our numerator. And when it says share, this is the average weighted common shares outstanding. That's our denominator. So we have for basic earnings per share, we have our net income of 154 minus our preferred dividends, and so our earnings for available to common shareholders is 150 million. Our shares outstanding 75, so we have a $2 basic earnings per share. And then we're going to layer in each of our dilutive securities that actually impacted the diluted earnings per share. So just recall, if they're anti-dilutive, we do not include them. And by each of these dilutive securities, how much incrementally did they affect the numerator and denominator? So we have stock options that increased the denominator by 3, the convertible debt that increased our numerator by 18 for the interest expense, and our additional shares issued for 12. We had convertible preferred stock that these were the amounts for the numerator and denominator. And so then we report the diluted earnings per share, our income, our denominator, and we say, oh, our diluted earnings per share is $1.85 compared to our basic of 2. And this would all be in the notes to the financial statements.